thank you for joining us at S&B Brew for our economic briefing. For this briefing, we're going to review over the performance of our community bank benchmark group for the third quarter. And if you recall, this benchmark group is made up of financial institutions with assets between $100 million and $5 billion. So let's start off at the overall level of return, looking at the return on average assets. Between the second quarter and the third quarter of 2020, we saw that overall level of ROA decline by just 1 basis point, going from a 1.15 down to a 1.14. When we're looking at that across the states here, what we find is there's a pretty large variance between the high and the low in terms of state averages. We look at the high out here in Arizona at 2.13%, and then the low down here in Hawaii at just 63 basis points. But it does span the spectrum. For the most part, most of the states are above that 1% return on average assets, and that's kind of the benchmark which we use for a good performing institution. When we look at the overall contributions from the different categories, the interest income category here, we can see it pulled off about 26 basis points from overall return on average assets. And that's simply because of where we are in the interest rate cycle, stuck down here at very low rates. That's spurring that refinancing phase which we've been experiencing. We look at the interest expense. Interest expense did improve by 8 basis points, but the combination between interest income and interest expense created that margin coming down by about 18 basis points. So those collectively pulled off about 18 basis points from the return on average assets compared to last quarter. Provisioning, we saw an improvement of 11 basis points, dropping from 32 to 21 basis points. So that's a good improvement. Hopefully, we won't see the credit cycle that we anticipated back in the second quarter, and we can start taking those provisionings back into income. Net overhead improved to 9 basis points, improved by 9 basis points from 177 to a 167, and that overall improvement was primarily the result of loan sales and the gain on loan sales that banks have been able to take advantage of. So that primarily gives you that contribution to that 1 basis point decline in overall return on average assets. When we're looking at net interest margin, we can see it continued its downward trajectory as we anticipated, moving down to a 3.38% for the third quarter, down from where it was a year ago at 3.84. So this overall level of net interest margin, as we look back into history, back to 2008, we can see we're well below the lows of that time. In terms of state-by-state net interest margins, we can see the highest out here in Utah at 4.5%, and then the lowest back here in New Jersey at 2.8%. So state to state, there is some variability as we move through the country. When we're looking at the components of net interest margin, that being the yield on earning assets and the cost of funds, we can see the yield on earning assets falling at a faster rate than the cost of funds. We saw yield on earning assets drop from a 4.1% in the second quarter down to a 3.87% in the third quarter. And then we saw an improvement of 10 basis points in cost of funds, dropping from 63 basis points in the second quarter to 53 basis points in the third quarter. Looking at that in terms of the yield on earning assets, again, we're down at the lows throughout history. because of where we are in that interest rate cycle. This is what we anticipated at the beginning of the year if rates were to stay low. And that, in fact, has happened. We are projecting, though, that this to continue to decline through the fourth quarter. And as long as rates stay where they are with a 10-year below 1%, we would anticipate that the yielding earning assets would continue to fall. And at the same time, of course, the net interest margin decline as well. State to state, in terms of the yielding earning assets, we saw a high out here in Utah at 5.2% and a low on the East Coast with both New Jersey and New York coming in at 3.48%. Quarterly cost of funds nearing its low. It's not there yet. We still have about 15 basis points to drop in terms of cost of funds, so we're getting down there. But when we look across the United States, obviously everyone now under 1% in terms of state averages. The highest out here in Rhode Island at 92 basis points, and the lowest cost of funds down up in Alaska at 19 basis points. So you have the flip in terms of land mass. You have the smallest state having the highest cost of funds and the largest state having the lowest cost of funds. In terms of quarterly cost of interest-bearing deposits, similar to the cost of funds, we're nearing the low. We're not there yet. Have about 12 basis points to go until we reach that overall low in the quarterly cost of funds. The forecast here on interest rates, when we're looking out to next year, this is looking to the third quarter of 21. Bloomberg consensus came in at about a 1.05%, so just over a 1% 10-year treasury out at the end of the third quarter for next year. And then you look at PNC on the lower end of the spectrum at just 86 basis points, whereas Wells Fargo puts that 10-year treasury at 1.2%. And that's what we need to think about as we're moving through this budgeting process into next year and thinking about ALCO, is looking at these rates, understanding how this is going to impact our overall level of yielding earning assets and cost of funds as we move forward. As I said before, I believe there is more room to move down on the yielding earning assets, more so than there is on the cost of funds. But I do think both of them will continue to decline as we find ourselves in this very low interest rate environment. In terms of net overhead, we had market improvements over the course of the past couple of quarters. Now, with the third quarter coming in at a 1.75%. The interesting thing is when we look at that number 175, historically we would have put that 175 as the level of a fairly efficient institution. So we see the overall level coming down to that level of that 175. I don't think that's sustainable. I do believe that net overhead is going to continue perhaps to creep up in here. A lot of that improvement has been because of the vast amount of assets we've taken onto our balance sheet through the PPP program and those stimulus checks. But overall, when you look across the United States, we can see the low level of net overhead, the lowest level in Arizona at 37 basis points, with the highest level in the Louisiana at 2.18. Now, of course, there are different components. We have non-interest expense and non-interest income as the two components. Both improved quarter over quarter. We saw non-interest expense get down to 2.49 and the overall non-interest income get up to 0.58. With that, looking across the map, we have the highest level of non-interest expense to average assets out here in Arizona at 5.99, with the lowest in Iowa at 2.23. Then we look at the non-interest income to average assets. High, again, out here in Arizona, and that's collectively, they offset each other, and they produce that very low overall net overhead. And then we had the lowest level of non-interest income to average assets in Hawaii at just 36 basis points. So collectively, you can review your numbers against the different outcomes of the average for the states. But what about risk? We talk about performance. Performance is looking pretty good considering what we've been through. But what about that risk? And the overall level of risk in terms of our S&B Total Risk Index has increased throughout the year, and quarter over quarter, we can see we're up just about to that 50 mark. We like to see banks stay below that 50 in terms of that risk score, but we are creeping up. A lot of this risk uptick due to, of course, the credit risk that's out there and has been increasing, but more so to the overall level of earnings at risk. We saw a pretty marked increase in earnings at risk because of the volatility that we've seen in that net interest margin coming through, not just bank to bank, but in the overall level here in the benchmark group, where we see that historically low level of net interest margin over the past 20-some years. And that's what we have for you today. We look forward to speaking to you again next week.